Hello, everyone. Thanks to all of you for joining us today. My name is David Chow, and I'm part of the institutional sales team at Barron Capital, and I'm joined by Randy Gwirtzman and Laird Bieger, the portfolio managers of the Barron Discovery Fund that was incepted in 2013. Guys, thanks for joining us today. I know you're eager to begin. I think good place to start is just talk about performance in the last quarter in 2022. I guess what would be helpful is just to talk about it against the backdrop of where we're just seeing continued focus on inflation, the Fed's continued efforts to tame it, and then just concerns around a potential recession. Why don't you guys take over from there?
Hey, thanks, David. It's Randy Gwirtzman here. So it's been a tough year for equity investors and fixed income investors, and everybody knows what's going on in the inflationary environment. I just wanted to give a couple of quick comments on what we think is going on, where we think things are going, and then how it affects the portfolio and what we're thinking about with regard to the small cap growth category in general. And what I want to leave you with is Laird and I really believe that this is a fat pitch environment, meaning when you're in the batting box and the pitch is a little slow and it's right down the strike zone, you may or may not hit it, may or may not hit well, but the odds are pretty good. We feel for a number of reasons that right now in this market environment, the odds are very good for a small cap growth as an asset class. And let me give you a quick couple of reasons why, and then I'll expound. First, in the economic side, we feel that a lot of signs are indicating that we're closer to the end than the end of the beginning, to kind of paraphrase Churchill, of the interest rate hike regime. A lot of the leading inflationary indicators have turned down really dramatically after the 450 basis points of interest rate hikes that we've seen over the past year. I'll talk about that in a second. Secondly, valuations in the asset class as a whole. You can look at our Q3 letter and see the charts, but it's very rare that small cap growth as an asset class has a lower multiple on forward earnings estimates or forward cash flow estimates than the S&P 500. We're at 930. We're in that area, and it's rebounded a little bit, but we're still, I think, slightly below or on top of S&P 500 valuations, whereas typically because the asset class grows a lot faster than the S&P, it should be a premium multiple. And the reasons are pretty obvious. I mean, it's risk-off environment. Laird called this a baby bathwater environment where people are risk-off at any cost. They're throwing out good with the less good, and because the liquidity is lower in the sector than it is in large cap, that's part of the reason why things tend to sort of oversell or overbuy, depending on whether it's a downside market or an upside market. Lastly, individual valuations within the portfolio we think are incredibly compelling. Laird and I are going to go at the end of the call through a couple of examples of companies we really like, why we think the valuations are just historically cheap, and why we have confidence going forward. So macro getting better, valuations low in the asset class, valuations really low in the quality growth names that we own, secular growth stories, and we'll get into the details. So on the macro, just to give a little more meat on the bone, our kind of working theory on what's happened over the last 2 years really is, if you look at a chart of M2, which is growth in money supply, we had growth in rolling 3-month money supply that was greater in 2020 than we've ever seen in the history of the country, and that's not an exaggeration. It's beyond any comparison. That was caused by zero interest rate policy by the Fed, which was meant to stimulate growth after the great financial crisis in 2008, but sort of continued, as well as the nearly $4 trillion of government fiscal spending. Back when I was in college, you kind of looked at Milton Friedman and monetarism, and there's a historic link between huge increases in money supply and risk of inflation, and then ultimately inflation. That is what we believed happened. It's pretty compelling. It's pretty hard to argue with. The question is, is this a type of inflation that's more run of the mill, like you'd see in 1990, 91, which Laird and I lived through, kind of a early 2000s post 9/11 recession, or is it something worse like a 2008 global financial crisis, or a early 1980s Volcker regime problem, where the Federal Reserve got so far behind under Reserve Chairman Burns that Federal Reserve Chair Volcker had to raise rates into the high teens in order to finally destroy inflation. A lot of differences between now and the 1970s. We don't think it's that. I think that this growth in money supply explains a lot of it, and the money supply is now negative, massively negative growth. We're reversing all of that, for the most part, I should say, with the rate hikes. We still do have some fiscal spending, but if you look at commodity prices, food, energy, if you look at the producer price index, everything is trending downward pretty massively. The housing market hasn't yet gotten there, but the housing market always lags because it's a transactional market requiring documentation and loan evaluation, et cetera. But what has happened in the real estate market, and it always leads, is sellers stop dead in their tracks, and there are no buyers of properties. And then prices have to come down, and ultimately transactions will happen months later if people can get financing. So all the factors for inflation seem to be going down, except for the one thing that people are most concerned about is wage inflation, which is real, but you're starting to see cracks in that as well. In some of the job listing markets are starting to turn upside down. In other words, there's excess supply as opposed to excess demand in some industries. And what's interesting is right now we have a 3.5% unemployment rate. It's really no different than it has been over the past decade. Maybe not that far back, but certainly over the last 5 years for sure. And that wasn't marked by a period of excessive inflation, even with zero interest rate policy, because we didn't have this massive stimulus. And so I believe that as we see, as the Fed sees all these things starting to ease in terms of prices, and the labor market starts to ease, and we're going to start to see higher claims counts, I believe, over the next few months, that will pause, or even lower interest rates if the jobless claims climb high enough. And typically, you get into the 350,000 claim range. They historically have always started to lower rates. So we'll see what happens. With regard to the market and small cap growth in general, small cap growth leads into a recession, meaning it goes down 6 months to a year prior historically, but it also leads out. And so we're not going to have to wait for earnings to bottom, or for the Fed to start lowering rates. I think it's just, you see the whites of their eyes, you see the light at the end of the tunnel. That's not an oncoming train, or whatever, hackneyed sort of phrase you want to use. The market will rally, and small cap growth will rally really hard. And that's where I really sort of believe this. It's going to be bumpy. It's not going to be pretty, but I think in the end, particularly given that we have this long-term view of the markets, and that the valuations are so compelling, as I mentioned before, I think we're going to be in very, very good shape. So with that sort of fat pitch thesis out there, we'll talk about what happened in Q4, and then we'll move on to a couple of characteristics of the portfolio, and then Laird and I can talk about some of the individual investments within the portfolio that we're really excited about. So Q4, the fund was flat. We were up just about 0.25%. And we were behind almost 4%, the Russell 2000 growth, which was up 400 basis points, 413 basis points. Of that underperformance, of the 400 basis points underperformance, about 100 or 25% of it was due to the fact that we have no investments in energy utilities or materials. That's by design because we believe that those tend to be more cyclical, and we're trying to invest in secular growth. So that part is on us in particular, but by design, and 9 times out of 10 that will help us, not hurt us. The sectors that did the best, consumer discretionary, we did a little better, about 66 basis points better than the index. Companies like Boyd Gaming and Cheesecake Factory did well. And then in financials, we were up 0.25% versus a flat index. We own a company called Kinsale that did well in the quarter, and that's an insurance company. The industries that did poorly, most poorly, were healthcare, which was down. The attribution was negative 2%, which is about 130 basis points, or 1.3% worse than the index. And it was really some stuff went up, some went down. The stuff that went down was more individual issues within the companies, which we don't think are serious issues or fundamentally alter the thesis as well. So the worst performers were Revance, which is it's a pretty exciting pharma company that makes a Botox competitor that lasts twice as long. The prior quarter, the company went up 100%, I think it was, and it was down significantly the next quarter as kind of the buzz wore off a little bit. And then actually in Q1 now, they pre-announced numbers in the first week of January that were far better than the street, 10 times better than the street expected on revenue for the new product, and the stock's up a lot again. So it's, there's nothing really to read into that. CareDx is a diagnostic company for transplant. There's some individual things going on with the company. I'll get to it later because I want to talk about it specifically. It is compellingly cheap, great franchise, a free cash flow break even with, a 300 million of cash almost on the balance sheet and a $600 million market cap. It's a compelling buy. So that was kind of the quarter in a nutshell. Let me just talk really quickly about, and by the way, pre-announcements. Surrounding the JP Morgan Healthcare Conference, which occurs early January every year, we always get pre-announcements. Of those pre-announcements, we had in healthcare about 8 companies beat and raised, and two kind of missed. And the companies that beat and raised were more important to the portfolio. Companies like Axonics, which is a medical device company for incontinence, Revance, as I mentioned, Progeny, which is a fertility benefits oriented company, and CareDx actually, that I mentioned before. This diagnostic company actually did better than people expected, and the stock has done well into the first quarter. So really quick, characteristics of the portfolio. Laird and I, beyond the individual stocks and the valuation, we think about risk management and balancing the portfolio. And we also want to kind of tell you where we're tilted a little bit, given our thoughts on where we are in macro cycle, and which we honestly tend not to think about too much, but it's overwhelming everything now. So I think it's important to have a thesis on it. Right now, we're in terms of, typically we're very evenly balanced in terms of industry with the Russell 2000 Growth Index. Right now, we are overweight tech by about 9%. So the index is around 20%, and we're around 29%. That's by design. Valuations, particularly in software, are incredibly compelling, as well as semiconductor stocks, very, very compelling. And we feel that we haven't honestly changed our allocation so much. It's just the index allocation's kind of gone down a little bit as well, and we're very excited about valuations and the company growth prospects for the individual companies we own there. Healthcare, we're slightly underweight, about 2.5%. We don't really own biotech, so that's probably most of the reason. And we're being very careful because a lot of healthcare has maintained decent valuation multiples, as opposed to other sectors like industrials and tech, which have really seen massive multiple compression. And that's due to the fact that people view healthcare as more secular, less affected by the overall economy. Industrials were a little overweight as well, 5% overweight there. Again, compelling individual growth stories that have been hammered. Our industrial companies tend to have a bit of a kind of tech component to them, and we think that there's going to be massive upside going forward. And our industrials also include our allocation to aerospace and defense, which we view as a little more non-cyclical or acyclical. And so we will continue to hold those and believe those two companies, Mercury Systems and Kratos Defense, have compelling individual theses as well. The allocation to high growth, and other types of investments is important to us as well. High growth is sort of 20% plus growers. Growth is more GARPy companies, it could be 10 to 15% growth, but we could still get our 15% sort of demanded return. It's what we hope for, at least, by growing margins as well as top line. And that leads to cash flow growth of 15% and hopefully expansion of multiples as well. And then the other category, which is things we view as relatively non-correlated to the overall market, could be companies that did a spinoff or kind of a restructured company, or just a more value-y type name, even though we're not real value investors. But a truly misunderstood fallen angel could be a value-y type low multiple company with higher organic growth potential. So we have about 38% in high growth, 42% in growth. That's pretty evenly balanced. We're tilted a little towards the GARPy stuff, which is a little less high beta, a little less volatile, and then about 16% in the other category. Something else we're kind of tracking now, which is interesting, and I think people should be aware of, is people view small cap growth as companies that are cash flow negative, losing money. Only 16% of the AUM in the portfolio is invested in companies like that are losing money. Everything else is invested either in cash, is about 4%, or break even or profitable companies. About 74% almost of our companies are cash flow positive. And so I think that's important. I think that's probably on the higher end of where we've ever been historically, and that's part of how Laird and I are trying to offset some of the risk of maybe allocating a little more to tech, but we're offsetting that by thinking about having more GARPy stuff as opposed to the super high growth stuff, and having higher quality companies that are a little more mature in terms of the cash flow. So it all balances out, hopefully. Weighted average market cap of the portfolio is about just over $4 billion. It's about $4.3 billion versus I think the index. I'm going to check in 1 second. The index is about 3.14, so we're a little higher than the index. We've had a chance to buy a couple things that are a little above the $3 billion index range, and the index is down 25-30%. So that's kind of my quick summary. Again, I really wanted to emphasize that we believe the odds are really good. When you read our fourth quarter letter, you'll see that we talk about market cycles, and particularly Howard Marks, his analysis of this. There are certain times in the market when you're just never going to know for sure, but things feel lined up. And I think if we're going to make a mistake, it's just that we're a little too early. But we really do believe the markets are going to turn, that the economy, that if the Fed does this right, we should have more of a softer landing than a hard landing in the economy. And I think they will, because I don't think they're going to let the labor market die a really hard death. They'll act before that happens. And so that all makes for this fat pitch environment. We're very excited. Let's get to some individual stocks so that you can see from the ground up as opposed from the top down what we're talking about. And Laird, why don't you start with a couple names, and then I'll jump in when you're done.
Sounds good. Thank you, Randy, and a great summary. So I wanted today to just go through and touching on what Randy had talked about earlier and our excitement around the portfolio and the opportunity to outperform over the next year to 2 years, and give you two examples of ideas that we really like. Just coincidentally, one of them was, at least within the coverage areas that I look at, one of the best performers in the quarter in Boyd Gaming, and the other one I wanted to talk about was actually the worst performer in my coverage area in the quarter, and that's Chart Industries. So let me start with Chart Industries first, since there might be some questions around why the stock was down during the quarter. But taking a step back, Chart Industries is an industrial manufacturer of equipment used in the production and storage of hydrocarbon and industrial gases. So its products include things such as heat exchangers, cold boxes, cryogenic components. There's been a lot of excitement around this area in 2022, especially because of what we saw with Russia and Ukraine. If you think about Europe and needing to build a lot of LNG terminals to compensate for the fact that they don't want to be taking gas from Russia, given that the political environment, the Chart Industries would be a prime beneficiary of incremental LNG within Europe. So there was a lot of excitement around the company. But in the fourth quarter, the company announced an acquisition of a business called Howden. Howden is also an industrial manufacturer that serves similar end markets to Chart. They just specialize in different products. They specialize in things such as compressors, blowers, and ventilation equipment. The market did not receive the acquisition well, and the stock was down about 50% as a result in the weeks following the acquisition. The key elements that people were not happy with were primarily around the amount of leverage that Chart was going to have to take on in order to buy the Howden, and Howden, which historically had been a public company back in the day and had gone private, but the company had changed itself during that go private period. But there was a lot of nervousness around looking back at what the business was before it went private. It's our belief that the company and the street are misguided in their feelings around Chart, or the combined Chart. And so unlike the rest of the world, we're very excited about the opportunity post the closing of the acquisition, which we believe will happen in the second quarter of 2023. Couple things that I wanted to touch on why we think the street misunderstands the rationale for the acquisition. First off, the deal was accretive to margins, to EPS and free cash flow in the first full year. The second thing that we liked was that Chart's bringing access to customers and commercial projects, including geographies that they didn't have in the legacy Chart. And when we spoke with management, it was very clear that management believed that they really needed these geographies and customers to grow in future years, and would not have been able to get them without significant investment in time and money. And so this brought that to them much, much faster. We think the combined company, when speaking with customers, one of the things that came out of that was that the combined company is going to be able to offer them a full solution, as Howden's going to add critical products to the legacy Chart portfolio. We also think, and this is probably the most important piece, is that it gives Chart a greater competitive positioning, and its focus on what they term the nexus of clean. So they're going after their growth markets such as clean power, clean water, clean food, clean industrials, and those are the fastest growing areas within the markets that Chart serves. At this point, the biggest positive, I think, from what we saw from investors when they looked at the deal, was the fact that Howden has high levels of aftermarket parts service and repair revenue. So it's much less cyclical and project based, and more steady state. Those tend to do similar levels of revenues and profits regardless of what's going on in the economy. As far as the deal itself, the financing is all in place. The company issued both equity and debt to do the deal. And as I mentioned earlier, I think there's some stress around the leverage, which will be above 4 times at closing. But we also believe that they're going to generate significant free cash flow in the first year and potentially do some dispositions that will allow that leverage to get under 2.5 times, which is their target within 2 years of the closing. And I should mention that our numbers are significantly lower than where the management has guided. Net, it's around a $6 billion market cap with around $4 billion of debt. So the enterprise value is a little over 10 billion. Our EBITDA in the first full calendar year is a little over, and that's going to be calendar 2024, is a little over $1 billion, which, as I mentioned, is below management guidance. But that being said, we believe that that's worth around 12 times, which gets you a stock price of about $200, which from here, the stock right now is around $125 or $126. And so, you're looking at a greater than 50% return. The other name I wanted to talk about was Boyd Gaming, which, as I mentioned, was a good performer in the quarter, or one of the best within my coverage. And Boyd is a gaming entertainment company, otherwise known as a casino company, that has 28 gaming entertainment facilities in 10 states across the U.S. Importantly, it also owns 5% of FanDuel, which is the nation's leading sportsbook operator. It has about a $6 billion market cap, and if you include and adjust for their leases, it has around $3.5 billion of debt. So it's just under $10 billion of enterprise value. The interesting thing with Boyd, and I think what the street is missing as it pertains to it, is that they're modeling EBITDA down 7% in 2023, just given the more challenging economic backdrop. While we are also modeling a slowing of the consumer, we believe that there is some incremental EBITDA opportunities that the street and the buy side are not reflecting in consensus. And so our estimate for EBITDA is flatter, is kind of flattish 2023 versus 2022, and not down. Those incremental opportunities include a new management contract for a casino in Sacramento, California. So a new project that they invested $50 million in downtown Las Vegas, and the fact that downtown Las Vegas is beginning to benefit from demand on the strip kind of overflowing onto downtown Las Vegas. They did an acquisition last year that we don't believe is in the numbers. That's going to add another incremental $20 million of EBITDA, called Pala, P-A-L-A. And that should allow them to put their Stardust online casino onto their own platform. Currently, it's on the FanDuel platform. And then as we look out to next year, they're investing money today in a casino called Treasure Chest, which will open for next year, and we think adds another incremental $30 million of EBITDA that we also don't think is properly reflected in analyst estimates, but that's looking out to 2024. So combining all that, and we believe that, as I mentioned, EBITDA will be flattish. The free cash flow yield is in the low double digits, kind of in that 11% range for 2023. The company is going to pay their 1% dividend and buy back a lot of stock, call it 8 or 9 or 10% of the stock, depending. And our target on this particular company, if you put a more normalized multiple and take into account that the EBITDA will be flattish, is around $170, and as you know, the stock, or as I can tell you, the stock is just below $60. So it's not quite 100% upside, but pretty close over the next 18 months. So we're really excited. It's a top 5 position, and despite the fact that it performed well in the fourth quarter, we still think it has a lot of upside to go. And I forgot to mention that 5% stake in FanDuel, which we don't believe the company is getting credit for today, could be worth $1 billion in time, which is significant given that the current market cap is only around $6 billion. So those are 2 things I wanted to talk about. Randy, I know, wanted to add a couple more ideas he was excited about, so I'm going to turn it back over to him.
Thanks, Laird. Those are great ideas, and as I mentioned before, we're excited about technology in particular. A little company called Couchbase, BASE, which I've spoken about before. I'm not sure on these quarterly calls, but it's a database company that does non-relational database. That's the old Oracle style where everything's kind of fixed in rows and columns. This is a more free-form type database. They compete with a company called MongoDB. We think the market for these types of database providers, non-traditional, is at least 8 billion. And Couchbase right now is doing 155 million in revenues in 2022, growing nearly 25% per year. We think those revenues will triple from 155 to 450 over the next 5 years. That's our investment horizon. And right now, the company's trading for only 2.4 times sales. It's a small market cap. It's a $590 million market cap. They've got 180 million in cash. We think they're funded well through break even. Very high gross margin business. It's a 80% plus, mid 80s gross margin type business. And recently the accelerant, and we're going to start to see this over the next year, is that they're now on all 3 major cloud provider platforms, whereas the product just a couple of years ago was an on-premise, meaning you had to install it and maintain it at your site, as opposed to it being a pure cloud product. Being a pure cloud product makes it much easier to deploy, implement. You can charge more because you're providing not only the software, but also the infrastructure services that go along with it. And it makes it much easier to implement because it's all virtually managed. So very excited about Couchbase. We think it's misunderstood. The stock's now, trading just around $13. And as we look out to 2027, just at 4 times sales, which is relatively low in the scheme of fast growing software, that $13 could be a $47 to $50 stock in a few years. So multi-bagger. The next company I just wanted to touch on quickly was CareDx. I mentioned before, they do transplant diagnostics. They are the leading provider of heart, lung, and kidney diagnostics, both prior to transplant to match organ donors with recipients, as well as post-transplant monitoring, which is really where most of their money is made, particularly in kidney. The company is a $770 million market cap company with 290 millions, on the balance sheet. So, a third of the entire market cap is cash. There's no debt, and it's trading for 1.3 times sales. The company has been going through. They're growing reasonably well. They were hurt a little bit in terms of transplant volumes due to COVID-19. That's starting to return, and there's a lot of things that are going to accelerate the growth of organ transplants, including improved transportation, and then some movement to approve organs that used to be non-approvable because of really an overabundance of caution. But the science and the transplant community has moved a little further on. And so, obviously that would increase volumes. And right now, we believe that particularly in kidney, the opportunity is only about 15% penetrated. CareDx is the market leader there. They're in at 70% of kidney centers and 90% of heart transplant centers. They do have a couple competitors, but those competitors have not yet been able to make a lot of inroads. And the nephrologists and centers that we've spoken with have told us that they like the service provided by CareDx much better than the competitors, which is very important because it's a patient-centric, very high-touch type of healthcare provision. And so we think that CareDx is very well situated. The stock trades at just under $14. One of the, I should say, two of the things that caused the stock to go down quite a bit is they have a mix shift that's moving from Medicare to Medicare Advantage. Medicare Advantage is provided by private, kind of commercial insurers, and they've been dragging their feet a little on reimbursement, even though they have to do the reimbursement. So ARs have extended on that, and accounts receivable collections have also extended on the shift to commercial payers. So CareDx is trying to get commercial coverage for the tests, and meanwhile, it's running the tests for commercial patients, even though they know they're not going to get reimbursed because they want to provide a kind of historical account of how good the tests are. There's no doubt from all the experts we've spoken with and from a recent CMS panel that this is moving to the gold standard as opposed to biopsy. But one of the other concerns is that CMS is kind of looking at, are the tests given too frequently, and are the ASPs, the test cost too high? We don't think either of those things are true, but even in a worst case scenario, we believe there's almost no downside from the current prices. Given where the stock's trading now at about $14, we think that our out year estimates give us a stock price. I'm just looking at my sheet. I apologize. Of 56, so 14 to 56. So it's 3-4 bagger, and that's only at 4 times EV to sales, and the equivalent of cash flow, because it should cash flow at 20 to 25%, would really be at about 20 times cash flow. So or 16 to 25 times cash flow. So those are two like really compelling names in healthcare and technology, which are kind of the bigger areas in the portfolio. We can give numerous other examples of where multiples are really in just unbelievably low territory, which gets us really excited. We think the balance sheets of our company, as I mentioned before, are really good. None of our companies need to raise capital. Sometimes they do, as Laird mentioned with Chart Industries, but it's for an incredibly compelling strategic growth opportunity, and those things happen. But what Laird and I are trying to do is, again, just to round it all up, bring it back to this high odds of success, fat pitch environment, but yet continuing to do what we always do, which is to buy high quality companies at the right price, to get our targeted 15% plus returns, to do it in a risk managed way, and to basically try to give our investors the best possible opportunity for success. And by the way, that includes us. And I've put more money into the fund over the last couple of months because I do believe in what I'm talking about. We're excited. We think things will get better. 2022 was a tough year, historically tough year, but we really are very optimistic about particularly the second half of 23 and going forward. And with that, I think I'll turn it back to David and wrap up.
Randy, Laird, thank you all very much. And with that, we are actually out of time for today's call. But anybody out there, if you do have any questions, please reach out to your sales contact, and we'll come back to you with a response. Lastly, just want to remind you all that we will be making a recording of today's webinar available on our website at www.baronfunds.com. So thanks again, everybody, for attending today's call. Most importantly, we want to thank you all for your trust and confidence in Baron Capital.